Hello, I'm Nathan Kubik, and thank you for joining us for the 2019 year-end Transform Wealth Capital Markets Outlook. Today, we'll be discussing recent events, what we are currently observing in the financial markets, as well as a number of noteworthy influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. The U.S. equity markets posted its strongest quarterly gain for the year, with the S&P 500 growing about 9%. This was largely a result of the progress made between China and the U.S. Further adding to this momentum was the Federal Reserve rate cut that occurred in October. From an economic standpoint, we have maintained levels of slow and steady economic growth and are maintaining course within the current Goldilocks economy. As we've been discussing throughout the year, the primary driving forces in the financial markets haven't deviated much. International relations, the trade war, the interest rate environment, and poor international economic data continue to be the main areas of focus. However, with interest rates coming down, the potential for the trade war resolution, and some signs of international stability, there are reasons to be hopeful in 2020. Let's take a quick look at some of the events that led us to where we are today. 2018 started off with concerns regarding interest rate increases and concerns regarding the trade war. This resulted in some initial volatility, but the resiliency of the markets held strong through the end of the third quarter. In the fourth quarter of 2018, the trade war began to escalate, and the Federal Reserve raised interest rates. The combination of those events resulted in a decline in the S&P 500 of 20% from peak to trough. 2019 started off differently. The market's negative expectations resulting from a trade war were overestimated. Valuations were already lower than historical averages as a result of the pullback, and earnings were expected to be hurt much more than what actually occurred. When earnings began being released, this became evident with a number of earnings surprises, and the markets began their rally back. That's not to say there wasn't an impact from the trade war, because there was, but domestically, we were able to economically absorb that impact and strive forward. It's interesting to see the near 100% reversal in the 2019 year-end when compared to the 2018 year-end. Fed rate cuts compared with the previous year's hikes, optimism about the trade war as opposed to the previous year's concern. We don't want to be complacent here, but the markets are appearing to be more bullish going into 2020. While the economy has improved, corporate earnings have stagnated a bit. We will discuss this later as the trade war is the major contributing factor, and that is expected to change. We've already discussed interest rates, but this further adds strength to the corporate balance sheets going forward. The election later this year is something that will certainly take center stage in the news. And while there are some meaningful areas that will move into focus, it is important to note that elections historically do not shift the economic state. Global issues including trade war, Brexit, and most recently Iran are some of the current key areas of focus. The domestic economic expansion continues to be the longest in history, but still the slowest in history. The Goldilocks economy of slow and steady growth with low inflation is continuing, and we feel well positioned economically going into 2020. Looking at the chart on the left, we see that new hires are continuing to rise, job openings are at very healthy levels, and that layoffs are incredibly low. On the right chart, we see that unemployment levels are at record lows, and we are continuing to see wage growth. These are all very positive indicators. One item to note is that inflation levels remain low at approximately 2%. Combine this with 3.7% wage growth at near historical averages, and we see individuals with greater purchasing power. This is something to watch as wage growth can contribute to inflation. However, we are not yet seeing that in today's markets. Here, we consider earnings growth from a global perspective. The U.S. continues to be the best performing market, and the rest of the world continues to struggle in comparison. Emerging markets are an area to watch. Their valuations are somewhat appealing, and there is some potential given the progress made between China and the U.S. However, While this is an area to be watched, we believe that it is still too early to know for sure. Europe has shown some very early stage indicators that could lead to longer term improvement. However, it is still currently struggling economically. And this can be seen in the equity market's performance. The gray line represents the return of the S&P 500 compared to the entire world excluding the US in purple. Since the bottom of the market in 2009, the S&P 500 has more than tripled the performance of the rest of the world. Valuations for the S&P 500 do look a bit high based on historical averages. However, there are a few items that we need to take into account. Due to the trade war and meaningful capital expenditures, 2019 earnings growth was relatively minimal. Thinking about a 30% return coupled with very little earnings growth, this could be viewed as a cause for concern. However, it is always critical to look at all of the moving pieces and not just one data point in isolation. With the lower interest rate environment, the likelihood of a diminishing trade war, and corporate projections going into 2020, we can see justification for these valuations. As an example, looking at the forward price to earnings valuation metric, we appear overvalued. What we need to understand is that the forward PE looks at the next 12 months of earnings estimates. Analyst expectations forecast another relatively low earnings growth first quarter of 2020. However, looking at the subsequent 12 months, this shows us a very different picture. And that is shown here on the chart on the left. As you can see, earnings did indeed stagnate, but are expected to resume their upward trend in the second quarter of 2020. Again, this stagnation can be explained primarily by the trade war. The chart on the right shows us that profit margins continue to look attractive. Companies have been able to absorb the impact of increased costs while maintaining their margins, and should the trade war abate, there is reason to believe that they could improve further. In addition to the trade war, U.S. companies have been making meaningful strategic moves to benefit their shareholders. The chart on the left shows us the primary uses of cash. One of the big areas of use is that of equity buybacks. This has been a strong contributor to the U.S. equity market's performance. Basically, companies will use some of their cash to buy shares back from the market. They generally do so when they feel their stock price is undervalued. In doing so, they lower the total number of shares outstanding. If total company earnings remain flat, they effectively increase their earnings per share without increasing the company's total earnings. Keeping valuation metrics steady, that in turn drives the equity price higher. The chart on the right shows us the actual impact to each sector through buybacks and dividends over the past 12 months. Large cap stocks have continued their leadership throughout 2019. The trend has been going on for 6 years with the exception of 2016, which was primarily a result of the election and the corporate tax change. Large value squeaked out a win over large growth for 2019. Small cap also had a good year of performance, but were clearly dominated by large cap. We continue to see domestic large cap stocks as the place to be in the equity markets, and also continue to believe that a more neutral positioning between growth and value is warranted. This can be seen on the chart on the right. These are the weights of our core equity model. The chart on the left shows us price to earnings levels by style class compared to that of their historical averages. We already discussed that the overvaluation can be explained by current market timing, but it is worth spending a moment to focus on small cap growth stocks. While the rest of the market seems to be similarly high based on that market timing, small cap growth stocks appear to be significantly higher. This is one of the reasons for our lack of exposure here. Growth often denotes companies whose revenue is more cyclical in nature, tied to discretionary spending, and is being awarded a valuation based on future expectations. While we believe these expectations are realistic for most asset styles, we feel that this is excessively high for small cap growth and something worth paying attention to. Sector returns were led by technology, communication services, and financials. Technology is our core equity model's largest overweight and had a 50% sector return in 2019. Financials came in just behind communication services, and if you remember from a previous slide, that sector, financials, had the greatest total return impact from equity buybacks. Energy, healthcare, and materials were the lagging sectors, but all came in with double-digit returns on their own. In our mind, technology remains the most attractive sector from both a growth potential and valuation standpoint. There are some sectors we find to be overvalued based on a chase for yield, and we need to be cautious and focus keenly on fundamentals in those areas. Sectors like utilities and real estate are at the top of that list, but even consumer staples deserves further attention to fundamentals. On this chart, we look at the S&P 500 sector weightings and that of our core equity model. As you can see, in our largest overweight, we are just over 5% overweighted to technology. Up until now, technology has looked undervalued based on its historical averages. However, like most sectors, valuations appear to be a bit on the high side. We need to go back to our earlier discussion on timing to understand that. It is worth noting that the relative overvaluation of technology is on the more attractive side of the spectrum, and we continue to see this as appropriate positioning. In our dividend equity model, our sector weights remain similar to that of the previous quarter. As we've discussed in the past, dividend stocks have been rewarded as interest rates have fallen. Due to this model's focus on increased stability and an inherent tilt towards value, there was not a need for any meaningful tactical shifts. Sector and style overlays remain strategic, and we will continue our focus on strong fundamentals and dividend growth. For all of our equity models, should we see problems related to geopolitical events, negative economic data shifts, or earnings growth begin to slow, we will be making a number of tactical shifts, and sector weightings will be foremost among those shifts. Moving on to bonds, over the past quarter, the Fed has reduced the Fed funds rate once again by 0.25%. As a result, the short end of the curve has shifted downwards, which has almost completely eliminated the inversion. We have been discussing this in past CMOs, and the market's expectations proved to be true. If you remember, last quarter we discussed the markets had priced in another rate cut. We further discussed the observation that the Fed was artificially holding rates higher than levels the market demanded, and that this was the cause for the inversion. We did not believe it was due to an impending recession. Now that a rate cut has occurred, we are seeing a more normal, albeit flat, yield curve environment. This has alleviated some concern in the markets and has created a relatively bullish outlook for most analysts in 2020. Another interesting item is that of foreign interest rates. Looking at the bottom part of the chart, we see that all of these countries' yields have moved higher, which infers a better global outlook. While there is still some negative yielding debt, the total amount outstanding is diminishing. All that said, there are still some areas of concern. One such concern is that of the national debt, and that is an issue that will need to be addressed at some point in the future. Here we look at charts that show the levels of debt taken on by the US, as well as the projections of debt in the future. While state and local debt, or municipal bonds, have remained pretty level, the federal debt level has been increasing, and this is not a US phenomenon. It's being seen all around the world, but it is something that we need to be aware of. Additionally, it is not just our debt, but also our country's future liabilities such as Medicare and Social Security that we need to be aware of. These are also growing at a rapid rate. The US is currently in line with debt to GDP ratios of other major countries around the world. Further, we are the largest and strongest economy in the world, which gives us a lot more flexibility than others. While it may be a while before this is addressed, this is a growing issue that needs to shift course a bit before it becomes a meaningful concern. And it's an issue that the rest of the world faces as well. As seen on the right, the U.S. debt has been growing, but so has the rest of the world, and the rest of the world has not been growing as effectively from an economic standpoint. In a low interest rate environment, this use of debt makes sense for economic growth. This is not a red flag concern, but it is something everyone should be aware of. From an absolute standpoint, our debt levels are okay and certainly fine from a relative standpoint to the rest of the world. This will also likely be a topic of discussion leading into the election. There's still plenty of time to make adjustments here, and it's important to remember that the US is the largest and strongest economy in the world. So in conclusion, given all available indicators and economic data, we continue to feel cautiously optimistic about what 2020 looks like. We feel strongly about the companies we currently own and the way we are positioned going into the next quarter. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures, with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, and we look forward to speaking soon.